assessment replies that you've all kindly completed and sent through, the key areas that have been highlighted as the areas that you as a collective have asked for in terms of the training. So they're the areas we've specialised on and gone into the detail on. So hopefully this will be a useful session for you all. We are, as I say, we are quite tight for time. So obviously some questions are welcome, but we'll obviously need to keep it going, I think is the important point really. But at this stage, any questions before we kick off? No? Okay, I'm going to start by handing over to Fiona from Legal Services. Thank you.
Good afternoon, everyone. I'm going to start this afternoon's training with some initial slides about governance. This image shows the various mechanisms of governance and guidance in place around the Central Pension Fund. The Pension Fund covers the staff of the County Council, all the district councils, the City Council, and Loughborough and De Montfort universities. So let's start with the Pensions Committee. The Pensions Committee have been given delegated responsibility for the management of the Leicestershire Pension Fund, and in discharging its fiduciary duty owed to all scheme members and employers, committee members essentially act as quasi-trustees of the fund when receiving advice and taking a position on fund matters. The committee's function is to decide the overall policy objectives, strategy and operation of the fund, making sure decisions are in accordance with the relevant legislation. The committee also decides the overall strategy for how pension fund money is invested and monitors and reviews those investment arrangements. Secondly, the Pensions Board. We are legally required under the Public Service Pensions Act 2013 to have a Pensions Board, and regulations set out its membership requirements. Unlike the Pension Committee, the focus is not on investments but on administration, ensuring the administering authority complies with the regulations, legislation and the requirements of the pensions regulator. LGS Central Limited. So Leicestershire is also part of a joint arrangement with 7 other Midlands local government pension funds: Shropshire, Cheshire, Staffordshire, West Midlands, Derbyshire, Nottinghamshire and Worcestershire, to form a pension scheme central investment pool with combined assets of approximately 55 billion and around 1 million scheme members across over 2,000 employers. We have a joint committee set up so representatives of each authority can oversee and monitor the delivery of the investment pool and challenge how investments are performing. The Department for Levelling Up Housing and Communities. So under the Public Service Pensions Act 2013, each pension scheme covered by the Act must have a responsible authority, which is the person who may make regulations for that scheme, and the Secretary of State is the responsible authority for the local government pension scheme. The SAB, the Scheme Advisory Board. This board has the responsibility for providing advice to the Secretary of State at the authority's request on the desirability of changes to the local government pension scheme, and then the Secretary of State must have regard to such advice. And finally, the Pensions Regulator. The regulator has oversight of aspects of the governance and administration of public service pension schemes, including knowledge and understanding required by pension board members, conflicts of interest and representation, and reporting breaches of the law. The powers of the regulator have not been extended to cover areas such as the funding and investment of funds, but the regulator does have a range of enforcement powers. You will hear more detail about some of these roles later in the training session. So a little bit more about the governance. So the Pensions Committee includes 5 county councillors, 2 city councillors, 2 district councillors, 3 scheme member or employee representatives, and 1 representative of the universities. It's really important to note that only persons and organisations with the necessary skills can take decisions affecting the fund. All Pension Committee members must receive training to enable them to critically evaluate any advice they receive. So the main duties of the Pensions Committee. The Pension Committee must safeguard above all else the financial interests of the fund's beneficiaries. Decisions affecting the fund's investment strategy are taken with appropriate advice from the fund's advisors. Committee members must be informed and led by their collective responsibility to serve the interests of all fund members and employers. Decisions must be taken in accordance with public law obligations, including the obligations of reasonableness, rationality, and impartiality. We also have an investment subcommittee, which has specific responsibility for appointing fund managers and monitoring performance. And the pension board is made up of an equal number of scheme member and employer representatives. The board's role is to assist the committee in its compliance with the Pension Regulators Code of Practice on the governance and administration of public service pension schemes, seeking assurance that due process has been followed, monitoring the integrity and soundness of the committee's decision-making processes, ensuring communication with employers and members is effective, and considering any internal and external audit reports. The administering authority. The County Council is the administering authority and is responsible for managing and administering the LGPS on behalf of its members. It can delegate that function to a committee and can decide on the number of members, their terms of office and its terms of reference. Management of the pension fund is a non-executive function, which means that by law it cannot be the responsibility of the Council's cabinet or executive members. The Council has delegated responsibility for the pension fund to the Pensions Committee, including the investment policy and the ongoing implementation of the fund. And support from officers and fund advisors. Senior officers of the County Council have been delegated certain statutory and formal responsibilities as part of the administrative responsibilities of the Council. Specific functions are delegated to named senior officers under the scheme of delegation, which sets the parameters within which the officers can take decisions and operate the day-to-day business of the pension fund on behalf of the Council. The County Council's Chief Financial Officer provides financial advice to the committee, including financial management advice, issues of compliance with internal regulations and controls, budgeting and accounting. This includes taking any necessary action between the meetings of the Pension Committee to implement the policy determined by the committee, admitting to the Leicestershire Pension Fund those organisations which are eligible for scheduled employer status under the Local Government Pension Scheme regulations, where the County Council has no discretion to refuse admission, and considering and determining requests for admission to the pension fund by those admission bodies that meet the regulations definition. Support is also provided from other County Council officers, the Director of Law and Governance, Assistant Director of Strategic Finance and Property, Head of Pensions, Head of Law, and Senior Finance and Legal Officers, as well as by an external investment advisor, Hymans Robertson, who you will hear from shortly. The Director of Law and Governance also has a responsibility to hear and determine any pensions appeals or dispute requiring resolution. So moving on to fiduciary duty. Members of the Local Pension Committee have both a fiduciary and public law duty to act in the best interests of both the fund beneficiaries, of which there are over 100,000 and around 200 participating employers, as well as ensuring it follows local government pension scheme legislation. Committee members have a duty to achieve what is best for the financial position of the fund. The level of risk involved in making investment decisions and the appetite for risk is ultimately a matter for consideration and determination by the committee, as long as it meets the aims and purposes of the fund. So the committee is likely to be acting unlawfully if investment decisions are approved despite receiving advice that such decisions would conflict with their fiduciary duty to the fund or risk lower investment returns. There are a range of potential conflicts of interest inherent in a local authority which administers a multi-employer pension fund, and the objectives of the administering authority, its officials and officers, and those of the pension fund are not always necessarily the same. However, decisions by the Pensions Committee must give precedent to the fiduciary duty owed to members and employers. So how do you exercise this fiduciary duty correctly when administering the pension fund? Firstly, by ensuring that committee decisions and actions comply with statute, regulations and case law, and by ensuring that you take proper advice. Secondly, by exercising your power of investment with care, skill, prudence and diligence. The committee's predominant focus should be what is best for the financial position of the fund, balancing risk and return. The pursuit of financial return is paramount and takes precedence over all other considerations. The primary objective is to ensure sufficient funding in the long term so that retirement benefits that employers promise to members under scheme rules can be paid when they fall due. As long as this remains true, the committee's choice of investment may be influenced by wider social or environmental considerations, so long as this does not significantly risk material financial detriment to the fund, and where views on investment are likely to be widely shared by scheme members and employers. So decisions to invest in or divest from a particular company should be made by an investment manager based on a holistic analysis of financially material issues, including environmental, climate change, social and governance issues. We have a dedicated conflict of interest policy for the pension fund, which I would encourage you all to read thoroughly. And I understand there are some forms that you need to fill in, so you need to go and see one of the officers about that if you haven't done that. So what is a conflict of interest and why is it important to your work on the Pension Committee? It has been legally defined by the Public Service Pensions Act 2013 as a financial or other interest which is likely to prejudice how you exercise your functions. So, if you have a responsibility or duty in relation to the management of or advice for the pension fund, and at the same time you have, for example, a separate personal interest, financial or otherwise, which relates to or is likely to affect your well-being or financial position, or that of anybody of which you're a member or in a position of general control or management, this presents a conflict of interest which may impact decisions made in the best interests of the fund. Committee members may well be active members of their LGPS fund. They may have strong personal views on ethical or environmental investment issues, or have a close or long-standing relationship with a particular advisor to the fund. All such situations have the potential to place committee members in a position of conflict. While it is recognised that some committee members may wear a number of hats, it is essential that all committee members recognise that the Pension Committee is not the forum within which to represent your own local political or private interests, but instead to ensure the effective stewardship of the pensions fund. So how can you protect yourself from failing to meet your obligations under the Council's conflicts of interest policy? Firstly, identify that an interest exists and make sure it's registered as part of your declaration of interests. Secondly, declare it appropriately at meetings and take necessary steps in relation to participation. Any member who considers they have a conflict must advise the chairman and monitoring officer prior to the meeting, where possible, and declare it at the meeting. The policy sets out a number of ways to manage potential conflicts of interest. Thirdly, continue to notify and manage any potential or actual conflicts of interest, making sure you update your declaration of interest as soon as possible if you have identified a conflict outside of a meeting. Finally, participate when the Council carries out its periodic review of conflicts. Respond and take action every 12 months when Democratic Services require members to review and update their declaration of interest. If in doubt, seek guidance and help from either Declan, Lauren or myself, and if the advice is that the conflict is unable to be managed or mitigated, then do not take part in any decision in which you are conflicted. Finally, for my part in today's training, you should also be aware of and apply the 7 principles of public life, known as the Nolan Principles, which are also integral to the successful implementation of the conflicts of interest policy. Those of you who've been members for some time will know this. They're all part of your code of conduct. Your code of conduct is based on the Nolan Principles. I don't want to go through them at any length other than to say that they may seem straightforward, but to apply them successfully involves consistency of focus and an awareness of where you can go wrong. In the decisions that you make at Pension Committee, ensure you are comfortable that they adhere to those values set out by Nolan. And that's me. Move on to the next section now. There is no next. Ian, there we are.
Good afternoon, everybody. My name is Ian Colvin. I'm Head of Benefit Consultancy at Hymans Robertson. Hymans Robertson is a firm. We work with the Leicestershire Pension Fund, advising on actuarial funding matters, investment matters, and governance and administration matters. And it's the governance and administration bit that I'm principally involved in. It's always a pleasure to come here to Leicestershire. Really nice people to work with. I'm quite a fan of the brutalist architecture too. That quite appeals to me. So it's good to come today, but I was slightly offended when I came through the lobby there and through the careers fair. I don't know if you came in that way. There was a sign that said, welcome to your start of your career journey. And they looked at me and said, you must be here for the pensions. It's around the corner. So a lifetime of LGPS is worn into this face. As we go through today, I know Ian said we're a bit tight for time, but I'm happy to take questions, and if there's any questions that you don't get a chance to ask, I'm happy to answer anything during the break as well. So what are we going to cover today? So this is a bit of an alphabet soup of a slide. There's lots of acronyms and abbreviations on there, and lots of topics, but the reason that we've brought these together today is that these are the topics that came from the recent knowledge assessment that was carried out, and these were the topics that were identified that as a committee and board, they were the ones that you wanted to hear a little bit more about. So I'm going to try and cover these off and bring some further background to these particular areas. So starting with roles and responsibilities. So I'm going to look at who's who at the national level, because it's important to think of when we think about the LGPS, we need to acknowledge that it is a unique pension scheme. So it is different to all of the private sector schemes that have their own rules, trustee rules and governance rules around them. So we are a public sector scheme and our rules are set in statute. So public sector schemes, the rules are statutory instruments set down by Parliament. That's what you have to follow. But we are different amongst all of the public sector schemes as well, because the other public sector schemes, the NHS, civil service, teachers schemes, they're all unfunded schemes. So there is no money sitting in a pot to pay pensions when they fall due to teachers. The teachers' pensions are just part of government expenditure. So it's just part of the general ledger of government. We are different. We're also different because the other schemes are centrally administered. One hub will do all the calculations. We are locally administered. So we've got 86 funds in England and Wales, another 11 in Scotland in a different scheme. 86 funds, each with its own entity, each with its own governance arrangements, its own way of working, but administering a single set of rules across the board, and each of these funds having a pot of money set aside in order to pay those pensions when they fall due. So we're very different to other schemes. We don't really quite fit into anything else, and that can be sometimes a challenge when we sort of get lumped in with the other public service schemes. So we're going to look today at some of the bodies, the regulators, the various different governmental departments and bodies that are interested in what we do in the LGPS. So here we have kind of who's who at the national level. Just to explain the colour scheme a little bit, I'll be picking out some of these as we go for a little bit more detail. All of these in pink at the top are bodies or parties that have the powers through the Public Service Pensions Act 2013. Now that was a radical transformation of all public service schemes, and that included the LGPS. So all of these bodies in pink you'll see here. Some of the others down the other sides have got more or less close relationships to the LGPS. They might influence it, they might be interested in it, they might have a role to play. But the pink ones are all have a sort of statutory responsibility. At the top there, you can see HM Treasury, and that's quite interesting. The fact that is at the top there. I think historically, if we thought about the governance of the LGPS, we probably didn't think about Treasury much. We'd have thought about the government department that was responsible for the regulations, but Treasury had a pretty high level view. They were more interested in the unfunded schemes. As you can imagine, that's immediate expenditure on their books. They were had less of a role to play in the LGPS. That changed with the Public Service Pensions Act in 2013. And from this point, Treasury has been much more involved, much keener to see the LGPS in step with the other public service schemes, even were that not a natural position for us to be in. And any big decisions at departmental level are going to go through the Treasury before they get signed off. So Treasury plays a key role. So we'll look at some of these bodies in order. So the responsible authority, and I think Fiona's already mentioned, responsible authority is a terminology that comes from the Public Service Pensions Act, and it's the person responsible for the drafting of the regulations and the running of the scheme at departmental level. And our department is currently Department for Levelling Up, Housing and Communities. So Secretary of State at the moment is Michael Gove. The Minister with LGPS responsibilities is Lee Rowley. Little bit of a question for people, no prize, but you get the undying respect of your peers. If we think back to January 2016, the Minister for the LGPS was a certain Rishi Sunak. So that was January 2016. Since Rishi Sunak and Lee Rowley, how many Secretaries of State do you think we will have had with responsibilities for the LGPS? That seems good. Higher, lower? Six. I'm going to give a prize for 6. There's 7 different iterations, 7 different ministers, but one of them did the job twice on 2 separate occasions. That was Luke Hall did the job twice. So I don't know who he annoyed in government, but he must have done something bad because it made him come back. But that's 7 in a short space of time, really, when you think about it. Some of those have been more or less engaged with the scheme. Some of them have never had a meeting about the LGPS at all. And that can be frustrating when there's things that need to be moved forward, consultations that need to be advanced, changes made to regulation. So depending on the interest of the individual, that can be quite a key role. So the role of the department, so that coming under the Secretary of State, is to draft the regulations. So recognising that the overall pension responsibilities that will be set out in Finance Acts, then you've got the Public Service Pensions Act that tells you, as a public service scheme, some of the things that you have to do. So what your benefit structure roughly has to look like. And then within that, each public sector scheme will have its own set of regulations, and that falls to DLUC to do that. And to support those regulations, there's a lot of guidance as well. So a lot of technical actuarial guidance, how you calculate a transfer, what to do if somebody retires early, all of that sort of stuff, as well as broader guidance on how to operate ill health measures or things to do with academy schools within the LGPS. So lots of important stuff needs to get done by DLUC to make the scheme operational. Although, as I said before, they're not entirely independent. Any big decisions are going to have to be cleared with Treasury first. So another party that has got responsibilities under the Public Service Pensions Act is the pensions regulator. So prior to 2015, the regulator had very little to do with public service pension schemes. There was a little bit around contributions, but they didn't really get involved. Since then, that's changed fundamentally. They have a key role now in ensuring the governance and administration of public sector schemes is sound. Now, that doesn't include the funding side of things, so the funding or the investment side of things. And that's because none of the other public sector schemes have funding or investment matters to think about. So we kind of grouped in with them. So that aspect of of how we run ourselves, the investment side of things, is outside of the regulator's view. But they still have a lot to do. They issue codes of practice, which you're expected to follow. Leave that on. They have Public Sector Code of Practice 14 is the current code of practice. We expect that to change any moment now, potentially, and I'll come back to that actually in a later slide. But at the moment, Code of Practice 14 brings together all of the expectations on public sector schemes. Worth pointing out that the regulator always thinks very much in terms of all public sector schemes. So they look for commonalities across the schemes and put guidance together based on that. And again, that doesn't always neatly fit into our locally administered funded model. They do have powers. They can issue improvement notices and fines. They can, if they see fit, impose somebody on a pension board, local pension board. They think that will improve, if it's necessary to improve the governance of that LGPS fund. They generally are quite collaborative in the way that they work at the regulator, so they're not out to punish people. The first step will always be explain the situation. If there's a problem, explain what's happening and try and work with the scheme or the fund to put things right. So we don't see a lot of that kind of action in terms of fines and what have you. I think there's been an improvement notice on Oxfordshire County Council, their pension fund, for they reported themselves for not issuing annual benefit statements on time. They got an improvement notice on the back of that process. And I think Barnet, London Borough of Barnet, was fined for effectively failing to respond to the regulator's questions. There's a fairly small fine, £1,000, something like that, but it set a precedent. Another thing that the pensions regulator does is publish a public sector toolkit. That's available online. Anybody can go on there. You can do sort of learning modules and then a series of questions on that module. It covers all aspects of the current code of practice. But again, bear in mind that is public sector wide. So it is not LGPS specific. So it's useful. Things like conflicts of interest, it covers those quite well. But some aspects of it, you need to dig a little bit deeper just to make that kind of LGPS relevant. So another body that was brought into being by the Public Service Pensions Act was the National Scheme Advisory Board, or the SAB, as we call it. That came into being in April 2015. Prior to that, it ran in a kind of shadow form for a little while, just to kind of get the mechanism working and to see how it would function. The appointments to the board are by the Secretary of State, and they are to be made. The phrase is something like with being conscious of the desirability of an equal number of scheme member and employer representatives. So currently there's 7 employer reps who are largely county councillors, also local councillors, and I think there's 1 from the who represents the education bodies as well. 6 scheme member reps who are come from trade unions. 3 observers who are kind of experienced practitioners within the scheme, and then various legal, investment, actuarial advice as and when required. So the point of the Scheme Advisory Board really is to give, because as a locally administered scheme, the thing that we kind of lack is one voice, in a way that other schemes would have that sort of single point of focus. We're very diffuse with our 86 different funds who can do things quite differently. So who represents the LGPS at that sort of national level? And I guess that's what the Scheme Advisory Board is there to do. It works in 2 ways. So it can works upwards to the Secretary of State, and it can request changes to legislation, which the Secretary of State is not obliged to carry out, but must consider. So where there's changes to regulation that would make the scheme run better, that would be better for members, that would be more efficient, they make those kind of recommendations. But they also disseminate information to individual funds as well. So they put out a lot of guidance. They do a lot of surveys to get like opinions across the fund, so we've got a kind of sense of what the LGPS as a whole is thinking. They will get legal opinions on sensitive legal matters or new legal precedents. So at the moment they've commissioned some insight into Sharia law and the LGPS and how that works. So they will do that sort of on behalf of all of the LGPS funds. One of the things that they did a couple of years back that I was personally involved in was what was called a good governance review, and that was looking at ways of improving governance, raising standards across all sort of LGPS funds. Any questions before I move on? Okay. So a couple of other bodies now that I'm just going to pick out of here. The Pensions Ombudsman has long been involved with the LGPS, so nothing new here. Gets Ombudsman powers through Pensions Act 1993, and the Ombudsman exists to resolve disputes between individuals and their pension schemes, and that can be personal pension schemes, private sector, occupational, public sector, across the board. The LGPS itself has a two-stage resolution procedure. So a member who is dissatisfied with a decision that's been taken by either their employer or the administering authority, which impacts them in terms of their pension, can make a complaint under stage 1 of the IDRP, and that will be considered by the body that made the decision. So one of the ones that we see probably most commonly is a member who believes that they should have been granted a higher tier of ill health benefit than they've been granted. Their employers said either you don't qualify for ill health or you qualify but not to the full extent. That's one that often comes up. So those stage 1s will go to the employer, who will reconsider the decision and then come back. If a member is still not satisfied after stage 1, they can go to stage 2, which is always considered by the administering authority. So even if the original stage 1 was about a decision made by the administering authority, it still falls to the administering authority to deal with stage 2, albeit it must be somebody removed from that original decision, somebody completely separate from it. And then if the member's still not happy after stage 2, they can take that to the Pensions Ombudsman, who will give a final decision. The Ombudsman's decision is final. It can only be challenged in a court of appeal on a matter of law, and the timescales for doing it are really tight. I think it's like 28 days or something like that, something of that order. So you don't see members really taking it much further once the Ombudsman's decision has been made. The Ombudsman does have what's called an early resolution process in place as well, and that allows members to actually speak to somebody who's part of the Ombudsman setup but is not formally considering making formal judgments. And that can be quite helpful because a lot of disputes and complaints come about often due to a lack of understanding. And sometimes if you've got two parties that have got different views and are just not communicating very well, the early resolution process can come in and just say, actually, say to the member, for example, look, realistically, I don't think it's worth pursuing this. It's very clear in the regulations. The fund has done the correct thing, and that can sometimes get it prevent it from going the full process. Said there, ill health is one that we see a lot of. Death grants. So the recipient of a death grant, where a member dies and there's a death grant payable, the person who gets that is at the discretion of the administering authority, and that can be quite difficult if people have complicated personal circumstances. So they sometimes come up for challenge. And increasingly recently, we've seen what's called pension liberation or scans, effectively, where members are encouraged to transfer their benefits out to a dodgy scheme, and the odds are they'll never see any of that money again. So over the years, we've seen more and more safeguards built into the process that any pension scheme paying out a transfer has to take account of. So more and more steps, processes that need to be done. And the Ombudsman's got more and more involved in kind of setting the parameters for those. So we'll move on. Local Government Association. Obviously, LGA represent local authorities, sort of, lobby on behalf of local authorities to central government, and they have a pension aspect as well, and that's the Local Government Pension Committee. So that's a political committee of the LGA. It's formed from LGA councillors, Welsh LGA councillors, and COSLA, which is Scottish Local Authorities, Confederation of Scottish Local Authorities. And it's the political balance of the LGA itself is represented on the LGPC. And their role is to represent the interests of local authorities in the pension world to central government. But they also have a secretariat and a team of officers who do some really important and really good work in the LGPS. And they put together, there's a monthly technical bulletin, which is pretty indispensable for anybody who administers the scheme. They do lots of guidance on things. They put together, I talked about transfers and all the steps you've got to go through, guidance on transfers, all the declaration forms that are required, technical guides, all kinds of stuff that really makes the scheme tick, I think. So an important role that they play. Sorry, so we've got there are a few of the ones we've looked at, some of the key ones there. There's a few others as well that I'm just going to sort of skip over, but trade unions represented on the scheme advisory board very often have a role. Like there will be a trade union representing scheme members on pension committees, pension boards, clearly looking after the interests of their members. They've got pension teams, got interest and views on how the LGPS should be administered. CIPFA, Chartered Institute of Public Finance and Accountancy, they're the public sector accountancy body. They put together guidance on how LGPS funds should put together their end of year accounts, how you report your annual report for the pension fund. Society of County Treasurers, but also borough treasurers and London treasurers as well. Obviously, Section 151s, very interested in the finances of the council, so interested in what the implications of the LGPS are. Pressure groups, media stuff. I think pressure groups in the last few years have become really there's a much louder voice, and that's coming very much from climate change. Many pension funds get frequent questions from local environmental groups about how they're invested, what are they doing about their investments. So that dealing with that, I think, has become increasingly something that the funds need to be aware of. And the final one down there, the pension officer groups. So each individual pension fund will send a representative to a regional pension officer group where they will discuss regulatory things, share best practice, deal with queries, and just kind of make sure, keep the scheme, share knowledge and best practices is the way that works. And then there's representatives from pension officer groups actually attend a national body called the LGPS Technical Group, which is the sort of national expression of that. And actually Ian's a vice chair of that, am I right? Yeah. So that's a helpful group as well. I will get moving. I do apologise. No. Well, what I'm aware of, I think a lot of this stuff we can probably get through quickly because I know like Fiona covered this as well. So the administering authority is the body in the regulations that is tasked with running the LGPS in that local area. So in this case, we're looking at Leicestershire County Council. Now, the common way to do this is for the council to delegate responsibility to a committee. That's what happens here, and that's what happens in most LGPS funds. It isn't the only way. Sometimes responsibilities are delegated to officers, and committees are just advisory. But this is the more standard way of doing it. There's also delegated responsibilities that come down to the investment subcommittee, and then other officers will be carrying out functions on behalf of the council in respect of the LGPS. You also have your Section 151 officer, who has particular responsibilities for the sound financial management of the council, and that includes the pension fund. So they will be very interested in some of the things that are happening. And the local pension board. So not a committee of the council, but a separate body under the Public Service Pensions Act, which is not able to make decisions on behalf of the council, but it is there to advise and ensure good practice in terms of governance and administration matters. I want to talk about the administering authority and that being Leicestershire County Council. What does that actually mean? At the simplest level, what is the job of the administering authority in respect of the LGPS? Collecting contributions from employers, member and employer contributions, invest those to get appropriate returns so that you can pay out pensions accurately to the right people at the end of the process. If you put it like that, it all seems very simple. There are some key people who have a role in that, and one of the ones I want to talk about is the fund actuary. So the fund actuary deals with that contribution collection side of things. That's what we call the funding piece. And essentially, they help the fund to manage risk. So the key risk that you have as a pension fund is you have to pay out a lot of pensions and you run out of money to do it. I mean, that's kind of what you're trying to avoid. And that's what your actuary advises you to avoid. Now, sometimes that can be on an individual member level. So I might do an individual member calculations in certain technical cases. New employer calculations or cessation valuations. So new employers might join the scheme, might come into the Leicestershire Pension Fund. A new employer actually advises on the risk, on the contribution rate, potentially on any sort of guarantee that needs to be put in place. And a cessation is when an employer leaves the pension fund. So is there a surplus? Is there a deficit? How do you deal with that? Outsourcing, if a function of the council is outsourced to a private contractor, staff might go with it. What are the pension implications of that transfer? Various other ad hoc advice, and then the triennial valuation and funding strategy statement. So I'll just look at those quickly. So the valuation is effectively a stock take health check of balancing the liabilities, i.e. the pension promises, and the assets that you hold. So what's the cost of benefits that have been built up to date, the future pension promises, and what assets do you hold? And your funding strategy is how you're going to make sure that the two balance. So you can have a high risk funding strategy where you say, we're going to really bank on high investment returns. So we're going to get the contributions in, invest, and we're going to get really high investment returns, which means we can have relatively low contributions, or vice versa. You could be very cautious to say we're going to have a high contribution rate because we're going to make very safe investments. Now, clearly that's an extreme. Somewhere between that will, depending on your fund's risk appetites, will be the right place to be. And that might be different for different funds. These two gentlemen are actuaries to the Leicestershire Pension Fund, so you might well be seeing them at future meetings. They're all right. I work with them. They're actuaries, but they're okay. So I'm going to come now to additional voluntary contributions. So this is a mechanism by which individuals can increase benefits at retirement. And they can do this by paying extra contributions into a money purchase scheme. And a money purchase scheme means they just pay the money in, they get investment returns on that money, and then they have a choice at retirement as to how they spend that pot of money. So it's not like the LGPS where they have a guaranteed benefit. They have a choice about how they can spend that. Employees can make regular contributions or one-off contributions. Employers can, in some circumstances, if they choose, pay into that fund, into that ABC fund as well. Contributions stay separate to the LGPS, and the way that they're invested is determined by the member themselves. So they choose the investment style that they want. Currently, the provider to Leicestershire Fund is the Prudential. Prudential historically been probably the biggest player in the market. I don't know if we've got time in, but there's been a bit of an issue in terms of Prudential. Yeah. Thanks, Ian. So once a member has invested in the AVC fund, they've got options at retirement. They can choose when they take the main LGPS benefits to take their AVC fund as cash, subject to certain HMRC limits. So some calculations to do there, but generally, I think most people take it as tax-free cash. They can buy additional pension from the fund, or they can buy an annuity on the open market. Almost always the additional pension from the fund is a better deal for the member. Or they can choose to transfer those AVCs out to somewhere else and then access them through a freedom and choice mechanism, drawdown type situation. So how much longer in? 10 minutes. Okay, I think we'll be okay. So some of the key priorities. So these are some of the things that, if you're already on the committee or the board, you've probably heard these names mentioned. If you're new, I suspect you will be hearing quite a bit about these. Various things: pensions dashboard, McCloud, investment pooling consultation, TCFD, and regulators code of practice. So starting with dashboard. So dashboard dates back to about 2014. It was a George Osborne idea originally, and the idea recognises that in this day and age, people move job a lot. People often have bits of pensions scattered around from different employments throughout their life. They don't always have sight of those, and they're not always in a position to make informed decisions at retirement. So what the dashboard does is bring all of this together. So any pension scheme has to have data available, which then feeds into a national dashboard. So a member can put in their own personal details, and all their bits of pension information will come together. So it's a sound idea. What it means for individual funds is first of all the technical side. So making sure that funds need to work with the systems providers to make sure that the information they hold is accessible, secure through to the dashboard. Making sure that the data they hold is accurate, because members are going to be looking at this data in almost real time. So it's not like sort of historically where you might have done one data cleansing exercise a year. This is about constantly ensuring that you're maintaining high quality data, so that members accessing it are getting the real picture. McCloud, probably the most uttered name in the LGPS of late. McCloud refers to a legal case, and it dates back to 2014/15 when the public service pension schemes changed the way they calculated benefits, moving from a final salary scheme, which meant that your pension at retirement was based on your pay at the point that you left, to a career average revalued earnings scheme, which means that your pension is built up each year based on your pay in that year. Most public sector schemes moved in 2015 from one to the other. We moved in 2014. Now, there was a promise made by government that no individual who was within 10 years of retirement on the 1st of April 2012 would be worse off as a consequence of this move. So schemes had to put in some kind of guarantee for those members. So what we did in the LGPS, we said, if you're in that group, you're within 10 years of your normal retirement date on the 1st of April 2012, we'll do two calculations up to 2022. So we will do the final salary calculation, we'll do a career average calculation, you get the better of the two. Now, in 99.9% of cases, it looks like the career average has been the better. Now, that was then challenged by, it was the judicial pension scheme member that challenged it. That's where the name McCloud comes from. Who said that's age discriminatory. And by definition, it is, right? Because you have to be, if you're going to be older than people who don't qualify, by definition, if you're going to be within 12 years of your NRD normal retirement date. So the court said that's illegal, you've got to put it right. So effectively what has to happen now is funds are going to have to go back, well, all public sector schemes are going to have to go back and put this right. So that is a big exercise. So there's a big exercise for LGPS funds. There's updating records for active members. So all members are now going to have that best of both worlds calculation, not just those who were in that protected category. And also there will be people who've retired, people who've died, people who've transferred out, who might also, you might have to go back, unpick those calculations and do that best of both worlds calculation to see if they've been disadvantaged as a result. So a lot of work to be done in McCloud. Pooling consultation. So pooling, just by way of background, pooling was an initiative by a previous LGPS minister, Brandon Lewis, and he asked the question, why have we got 80 odd LGPS funds? Why don't we have 10? Why don't we just merge them all? So that was his sort of big idea. There was a lot of fuss around that. Eventually that was not taken forward, but what was taken forward was the idea of investment pooling. And investment pooling meant that funds would come together and they would invest the money collectively through an arrangement called an investment pool. And that meant because you were going to a manager with a bigger pot of money, you would get better fees, you'd get the economies of scale from that. And also government was keen to see funds accessing asset classes that they might not be big enough to access on their own, particularly things like infrastructure investments. The key thing with pooling is that the individual fund sets the investment strategy. So it is for the fund to say, these are the types of assets that we want to invest in. The pool will then determine which investment manager provides the best in class or that particular asset class. But the strategy sits with individual funds. And Leicestershire is one of the funds in the LGPS central pool. Now, the pooling consultation originally came out in 2019. There was some controversy over it because it referred to the need for each fund to look collectively, at costs within the pool and across the LGPS. So effectively, it was saying to LGPS funds, you might be worse off as a result of this particular decision. But if it means that some other funds are better off and in aggregate they're better off more than you're worse off, then that's an okay decision. And that really clashed with the idea of fiduciary duty. It really clashed with the idea of, of looking after your own LGPS fund. So it caused a stink at the time. The guidance was pulled, and we've been waiting for it ever since. So at the moment, there's a whisper that it might be out before the July recess, but we have heard that many times before, so that's not a promise. Some of the things that have been rumoured to be in it, and I emphasise that, are fewer pools. So actually, got 8 pools at the moment. Do you bring those pools together to have fewer of them, but bigger pools in excess of, say, 50 billion? All listed assets to be pooled. That's one bit of speculation. So that's more than we do now. And maybe some requirement to invest in some of those kind of bigger infrastructure things that government like, venture capital, that sort of stuff. So we shall see what's there. TCFD. So this is something that is in the private sector, and it requires pension schemes to be very explicit about the way that they deal with climate risk in investment decision making. And TCFD is being adapted and is going to become part of an LGPS requirement. So effectively, it's the risk from investing in industries that might not have a long-term future, stranded assets if you invest in those kind of companies. So what's the governance around that? What's your strategy as a fund for how you deal with climate risk? And what metrics do you use and how do you report on that in terms of transparency? Pension Regulators Code of Practice. Presently, we have one code of practice for the public sector, and we have numerous codes that cover all different aspects of the private sector. What the regulator has said is they want to bring together all of the codes into a single code, and the idea for that is it makes it more uniform across schemes, so you've not got different standards in public and private sector. They argue it simplifies it. I'm not sure it simplifies it from our perspective because we've got one code at the moment, so it is nice and simple, but maybe across the piece for everyone. Easier to navigate, easier for them to update and maintain. that we're awaiting that at some point. That's going to go before Parliament for a for a consultation, effectively. So that could be any time now. But again, we've been hearing that for quite some time. So sorry about overrunning slightly there. Do you want me to go on to the training piece? If we've got any questions?
Quick question.
Yeah.
You mentioned LCC is one of 8 owners of the LGPS Central.
Yeah.
And we're also investors in the same fund. Does that pose a conflict of interest? And how is it being managed? It'll be useful to know.
Yeah, well, I think that's a really good question. So yeah, the council is both a part owner of the pool and also receives services from the pool. So I mean, there might be others probably better place to discuss the mechanics, but what you need to have is that separation of ownership from the client side piece. So in a way, you need to treat the pool from the fund's perspective. The pool is delivering a service to you, and that's the primary interest of the pension committee and of the those who are operating the fund on behalf of its members and employers. And then there's a separate part of the council that has a different view, as they are part owner of the pool. So yeah, absolutely right. There needs to be mechanisms in place to ensure that there is that separation. Yeah. Yeah. It's an eternal debate, and there's always a push and pull. So certainly of late, this interest in investing in infrastructure has been a big thing that the government's keen on. They kind of, I think they sometimes view LGPS money as a sovereign wealth fund that they can direct, but the problem is they know they can't go too far, because if they direct funds to invest in investments that don't deliver, then who's going to be picking up the baby at the end, because if they're not the appropriate investments for that fund. So there's a tension there. You tend to see government will make a suggestion, there'll be some pushback. At the moment, it tends to be very small numbers that you're dealing with, like a few percent in infrastructure, that kind of thing, which might not be entirely material. But yeah, it's definitely a tension that exists. Yeah, sure. Yeah, certainly. I mean, they're called shared cost AVCs. So you could have a situation where an employer just simply, as part of the contract, agrees to pay some additional money in as a part of an AVC. That's unusual. It's an additional cost. Employers aren't typically going to take that on. But what you do sometimes see more and more now is what's called salary sacrifice AVCs. So effectively the employer will say to the employee, part of your salary, we'll pay part of your salary as an AVC contribution into a shared cost AVC fund. So the employer saves NI on that, and then the member is getting a tax-free contribution into the AVC fund that they can then use at a future date. So that's a scheme that employers are looking at as a kind of cost-saving measure. Really quickly.
Are we ready to continue? If that's okay. We're very conscious. There's a lot of things to go through, which obviously these are the points that have come up from your assessments. But we do want it to make it two-way as well. So please, if you do have questions, do feel free to ask. Is that all right? So I'm going to hand back to Ian, and he's going to go through a very quick demo of the online. Thank you.
Yeah, so it's on a very quick note. Yeah, so this is a product that put together by Hymans Robertson called LGPS Online Learning Academy, LOLA for short, and it answered. It's designed to answer a need that we were hearing a lot of from committee and board members about the difficulty of accessing training in a convenient way. Sessions like this are great, of course, but sometimes you want something short. You want to refresh your memory on a particular topic. You just want an introduction. You want to do 15 minutes that's relevant to an upcoming committee meeting. So that's what this product is designed to do. So the way it works, you get your own personal login. You can go into it at any point. And when you go in, you will see various modules that between them cover all of the expectations of the Pension Regulators Code of Practice and the SIP for Knowledge and Skills framework. So you can log in and you will see within each of these there's a video, or it might be more than one video depending on the topic.
Members exceed £14 billion every year. So without question, the LGPS plays a crucial role in our local communities, delivering high quality pensions and ensuring good.
Pause my boss. When you go into each video, first time you watch it, you have to go from start to finish. But once you've been through that video, you can then whiz back, review bits that you want to go over again. You can watch it in any kind of order. So you watch the video, get your general introduction to that topic. Also, you can see a copy of the presentation with the script that's used. So if you actually just want to go back and actually, you want to read the text, that's available to you as well. There's also a slide deck that's available with you can make your own notes if that's how you want to do that. At the end of each video, once you've completed the video, you can do a learning assessment. So a handful of questions, multiple choice questions related to the topic that you've just seen, and that will give you a sense of how well you've picked up the topic. Maybe that give you a clue if you want to go back and rewatch one or two of the videos. Different numbers of videos in each of the sections depending on the nature of the topic. We also have a current issues module. So current issues. So in there, we'll update that with topics as and when something happens. So if we get wind of the pooling governance consultation, or single code of practice, whatever it may be. We'll probably put something in there just to give you like the current issue that's been talked about in the LGPS. Yep.
And then how do you get out? Because I lost the will to live and I won't do them. Because once you go on to the next one, yes, you haven't done module 1. So do you have to pick something to make sure that it knows that you've done the module?
You have to complete the watching the module, and then you complete the questions and then submit those questions at the end.
So you have to press submit.
What I will do, if I can take some details, we'll get in touch with you and we can address that particular question rather than do it here. Yeah, I'm happy to do that. You can also see a summary of all of your results, how you're doing in all of the different modules. And also officers can add in additional external training that you might have done from elsewhere. If you've been on an external course or something like this today, can be input into the system. So there's a single record of all of the training that's been carried out by committee and board members. So useful for things like regulator compliance and that. I will leave that there now, and we can move back.
Objection, I'll sit down. Can you just mute your mic down? Will that work then? Is that okay? I'll sit, not because I'm ancient, but because it's a bit warm and I can handle my papers better than on the restricted space here. Right, let's see if this works. Yeah, excellent. My name is Keith Bray. I'm from the Local Authority Pension Fund Forum. Time is short, so I shall press on. I have a few slides, not too many. So that's the bad news. The good news is they're all quite simple. So we can get, first of all, the context. We've talked today, and Ian's talked about the LGPS in England and Wales. And these figures relate to that. These are the figures from the SAB, which you've been told about this afternoon. This is from their 2021 annual report. 350 billion almost. If you include Scotland and Northern Ireland, it's obviously north of that. So you're approaching 400 billion. And you can see the number of members and employers and so on. And it's the largest the funded defined benefit system in the UK. And we think it's probably the 7th largest in the world. And I've given the source there where this has come from. I've summarized at the bottom. In short, the LGPS as a whole is a very, very significant institutional investor, both nationally and internationally. I'm going to be talking about investments, not about administration. Earlier on, Fiona covered this subject in much more detail and much more fully than I'm going to, but just to allude to it, again, to repeat, when it comes to committee, your job is to manage assets, to pay pensions and to pay pension benefits. And that's what it's about. It's not to put the world to right. It's not to do good or to hug trees. You're there to pay pensions, but obviously as a public authority, you would want to, as you go along, to hug trees and do good when you can do so without harming financial returns. And we believe that can be done. I'm not behind the times here. It used to be called the Department of Communities and Local Government, no levelling up and so on. I've left their name at the bottom because this is an actual quote from one of their regulations. There are lots of musts, and the first must relates to what I've just said. But then they did include for the one, I think it was when, if not the first time, one of the first times, a should. And they there said you should take account of ESG issues, as we call them, environmental, social and governance issues. Okay, come on to the LAPFF, and you are members. I'll come back to that in a second. Let me look at my own slides here, because I've got a few ancillary notes that I wanted to mention. I actually came here and spoke to your committee in February 2019, shortly after you joined. And at that point, we had 80 members. We've had 7 funds have joined us since. And because we cover the whole of the UK, there are actually 98 funds in total in the whole of the UK. So there's only 11 more to get. 6 of those are in Scotland. 2 issues there, of course, to come to meetings. It's helped with online meetings, but to come to meetings from Shetland is a bit challenging. And secondly, of course, they are very, very small funds. So that's part of the reason that they haven't joined yet. Having said that, my most recent recruit was a London Borough, Hillingdon, but prior to that, it was Scottish Borders Fund. So we're actually making progress there. We already have the 4 largest funds in Scotland as members. The forum has quarterly members meetings preceded by an executive, and all the members invited to make nominations to the executive and so on. That's done once a year. And you can, I would commend to you when you have a moment, just go onto Google and type in LAPFF and you'll go straight to our website. You'll get that straight away. And there's a lot of information there, including our annual reports. And we produce what we call quarterly engagement reports, which show quarter by quarter what we've been doing in terms of engaging with company. Engagement is the key word. So what we're about, I've just said, we're about engagement, and it's about, our aim is to protect and enhance shareholder value by taking account of ESG issues, where we think those issues within a company in which our members have already invested. We only engage with companies in which our members are investing. We do a survey every year asking our members to tell us which companies they're invested in, because we can then be sure. I mean, if there's a problem with the company, but none of our members, or very, very few, are invested, we wouldn't get involved. There has to be a significant number of our members invested in that company, obviously, to make it appropriate for us to take up issues with them. We issue occasional voting alerts. I think we did about 20 or so last year. And they are for you to discuss with your members where we think there's an issue, and we're saying you should discuss with your fund managers whether or not they agree with you and us that you should vote a particular way in this particular case. The forum, because of our numbers, provides an excellent forum for consultation on and sort of networking, to use that horrible word, on responsible investment. We also sponsor an all-parties parliamentary group at Westminster. The most recent one we had, and this ties in quite nicely with what was said earlier, was the main speaker was Lee Rowley, the latest of our ministers. The next one that we have coming up, and it's in a few weeks' time, is again ties in with what has just been talked about in the question we had, and this is with the chief executive and the chairman of the venture capital group, talking about investing in those sort of things, which we think there may be some pressure to put on the LGPS to go along that line. I would certainly echo the comment made by one of you earlier on, namely that you know, that really has to be seen not to be in conflict with your main fiduciary responsibility. And you know, who knows? Depending on the way it goes, it's even possible that might, like MacLeod, that might end up in the courts again. Who knows? I don't think it will, but I wouldn't rule it out as a possibility, depending on what might happen. We hold an annual conference in December, and that's held in December in Bournemouth. We did get a lot of snow one year, but it's a nice venue and so on. And we get top speakers. We get lots of speakers from the investee companies. I think I've listed some names here. Bear with me just 1 second. Upside down, is it? Right. We had Robert Peston speak last year. In the past, we've had Michael Heseltine. We had, going back a few years, we had Kenneth Clark, I think just before lockdown. Political balance, 1 year we had Alistair Campbell and so on. So lots of big names, apart from having, as I say, leaders from industry. We do have the chief executive of BP lined up to speak at this year's conference. So again, it shows the extent of the fact that we can have some influence, and it facilitates collaboration. And this is the important point. It's not just nationally, but internationally as well. The areas of concern, I won't labour this, you can just read them. Obviously, top of the list at the moment, and has been for a few years now because of climate change, environmental issues, human rights issues, and so on, relationship with communities. I'll come back to that. Supply chain, labour standards, this is on the social side. And then on the governance side, board structures, diversity, obviously gender balance on boards, directors' remuneration, and so on. I'll leave you just to look at those. Our executive manages the work of the forum. The executive is made up primarily of elected members who are elected by our whole membership annually, and any fund can nominate anybody from within their fund, and then there's a vote to get onto the executive. They manage the forum and manage the budget. They manage the implementation of the work plan and oversee the annual conference. They appoint a research and engagement partner. We use a firm called PERC, and they do all that's the major contract, obviously, by far. They do all the work in terms of researching companies, and then when we engage with them and the executive members who are councillors such as yourselves, when they go to meet the company, they brief them and prepare briefing notes and so on, so that they are on top of the game. And certainly the elected members who take that role are all very, very happy with the service that they get and feel very, very comfortable about the job they're undertaking. They also appoint me. My background is local government finance, and I mean, to put it rather more simply, I'm the sort of recruiting sergeant. I've been doing it for a while. When I started, we had 25 members. We now have 87. So we've made some good progress, but you know, it did start in 1066, as I've just said. We report our activities quarterly to the members' business meeting, and that's when all members attend. Latterly, we've been holding them virtually as well as in person. We've had hybrid meetings. Obviously, during lockdown, we had virtual meetings via Zoom. But we have now started to have hybrid, and there's a debate going on as to whether or not we should continue with the virtual as well in a hybrid form. That's still being discussed, as I understand it. We have a work plan that is set up every year. Often it reflects what's been going on in previous years, obviously. All LAPF members are invited to make comments or suggestions. And this is usually at the end of January, they're asked. They're given a month to put information in by the end of February, and then it comes back. The executive looks at all that and puts forward a final programme to the April meeting of all the membership. So the final work plan is approved by all the membership. I'd now like to just talk briefly about some engagement results. This is where we've actually engaged and there has been some impact. This one is a very old one, but I make no apologies for putting it on. It's Marks and Spencer. It goes back to 2009, but it was our watershed moment. It was from this moment on that we were really recognised. We had the only non-board sponsored resolution at the M&S AGM, which was held on the South Bank in London. And I went to that meeting. I didn't speak, but our chair did at the time, our chairman at the time. And it was the only non-board sponsored resolution. And it was our concern that Sir Stuart Rose, who we thought was a great chief executive, we had no problem with him being chief executive. But when the previous chairman stood down, he took on both roles. And we didn't think that was right. It was contrary to generally what was seen in the combined code as good practice at that time. The other two main points I'd make, it's too much power in one set of hands. And if he's hit by the proverbial bus, then you've lost both your chairman and your chief executive at the same time. So it's not a good idea. And we didn't want him to go immediately. We wanted him to, because he said it was going to be 4 or 5 years until somebody emerged from his management team as a new chief executive, and then he would move on to be chair only. We didn't think that was appropriate. We got a lot of coverage in the broadsheet media. In fact, there was a great blog the following day by the editor, the merchandising editor, or of the Daily Telegraph, and he referred to our motion. He went through motion by motion what happened, and he went through called our motion the biggie. But when you're called the biggie by one of the Daily Telegraph editors, you've sort of arrived. The broadsheets thought that our members held 4 to 5% of the M&S register. In fact, we held about 3.5%. But as you'll see from the screen, when the vote came, despite the board recommending all shareholders to reject our vote, 37.7% of shareholders rejected the board advice and voted in support of our resolution. In fact, another 4% abstained. So 40% of M&S shareholders actually gave a very strong signal. Now, for it to have carried the day, because it was a constitutional issue, it would have taken a 2/3 vote, not just a 51% vote. We didn't want it to carry the day because we didn't want, if that had happened, if it had gone over 50, Rose might have walked off straight away. We didn't want that to happen. We just wanted to promote change. And we did. At the time, on the day, he dismissed it. The motion is lost, which it was, and so on. But it was, I've been told that it was the second highest, the highest, only one below it, of a non-board proposed resolution. Only one other had ever got above 20%. And nothing had ever been as high as that for a FTSE 100 company. Subsequently, Mark Bolland, who at the time had been chief executive at Morrison's, he was appointed, and he was appointed in the autumn. I think it was in October. He wasn't going to take up post until January 2010. But the day his appointment was announced in October, the M&S share price went up 5.5% that day on that news, clearly demonstrating the link between governance and share value. Shareholders thought this is a good thing, you know, and so on. The subsequent incoming chairman, when Sir Stuart stood down, Robert Swan, who came in from the city, he in fact spoke, as I've said earlier, we often get chairs. He spoke at our subsequent conference, and we've not needed to have close contact with him, but we've had very good contact with M&S since that time. Coming more recently, this is very recent. At the end of last year, our current chairman, Councillor Doug McMurdo, who's chairman of the Bedfordshire Fund, he visited Brazil, because there was concern about the collapse of the tailing dams. I don't know if you know about this, at Mariano and Brumadinho. They were ecological, social, and financial disasters. The companies have had to pay out billions, or will have to pay out billions, in compensation, in lawsuits, and in restitution, putting things right, because they hadn't been looking after things properly. During the visit, when the chairman met with local communities, business leaders, and investors, one person he met with was Mr. Jose Palladino, the chair of Vale. Vale, or I say Vale Valley, it's one of the, I believe it's the largest company in Brazil. And he was very, very supportive and responsive. And he then came to our AGM, to our conference last year, at his own request. He said, I'd like to come and speak. He came across at his own cost and so on, and spoke at the conference and gave an assurance. He's a new chairman, he's got a new board, and he gave assurances that they were going to tackle the problems and make sure that things were done very much better in future. The other major company involved along with them was BHP. And this just demonstrates how difficult and challenging things can be. BHP would have nothing to do with us. They wouldn't meet, they just didn't want to know. However, our chairman, Doug McMurdo, is meeting BHP next week. So you just keep plugging away. You don't always get success. And quite often with these issues, success takes many months, sometimes even years. But you have to keep plugging away, because if what you think you need to do is right and so on. I should say, by the way, we never ever give any advice. We're neither qualified nor are we allowed to give any financial advice. So we don't advise our members ever what they should or shouldn't advise in. That's between them, their financial advisors, their fund managers and directories and so on. Nothing to do with us. When they have invested, we then look at what they've invested in and see if there are ESG problems. ArcelorMittal, this again is it's the largest steel company, the steel producer in the world. There's an organization called Climate Action 100 Plus, over 100 investors, and we've taken the lead on a number of issues, and one was along with somebody else with ArcelorMittal, and it's a family ownership and so on. We met with the current CEO, Aditya Mittal, following his father's standing down, and we had very, very positive feedback from that meeting, and they've talked about doing things. We're keeping in touch with him, and they are saying that by 2025 their Spanish plant will become the world's first zero-rated carbon emissions, because this was all about carbon emissions and climate change and the problems that can be caused there. National Grid, we've had a long-standing relationship with National Grid. Been working with them and attending their AGM since 2013. We had the chairman, Sir Peter Gershon. He came and spoke to our conference in 2019. There are still some issues that our engagement partners are looking at with them, but basically, again, it's an ongoing positive relationship. Financial Reporting Council. Now, this is not strictly speaking investment. This is not a company, but we do get involved in wider areas as well. We were concerned, you'll all remember the banking crisis. We were concerned that the major accountancy firms, they were signing off the bank's accounts. Nobody said that Royal Bank of Scotland needed the billions of pounds that they did. And subsequently, we were told that's what they needed, and it was taxpayers who had to fund it, and of course the share value suffered as well. More recently, there was Carillion. There was a problem there. When that went bust, we had issues at BHS, Tesco, Patisserie Valerie, and we felt that this was because the Financial Reporting Council's rules, which were giving the guidelines by which accountants should report on companies, were not really fit for purpose. and we were lobbying. This took several years, and we produced a number of reports and so on, particularly starting with the banking crisis, but following on some of these other issues. Then in 2018, the review was led by Sir John Kingman. He was a former Treasury Mandarin. He was I think he was the permanent secretary at the Treasury. He'd moved on. He was chairman or is chairman of Legal and General. And as a result of his review, he referred to the FRC as a ramshackle house. And it was decided, so if you like, I mean, not something people like saying or like hearing, but told you so, we could have said. We didn't say that, but we might have done. We felt it just wasn't fit for purpose. They had a new chief executive, Sir John Thompson. He spoke at our conference. He's actually a SIPFA member. He started, which I didn't know until I heard him speak. He actually started his career in local government in Somerset and then moved on. He was formerly at HMRC and then moved on to ARGA, the Audit, Reporting and Governance Authority. And that, I think, is just taking up its role now. So those are the examples. Where are we now? We believe we're really making a difference. Public support, because people understand that these issues can have an effect on their pensions. Having said that, of course, LGPS pensions are all guaranteed by statute. So if you actually mess up on the investments, it's your council taxpayers who have to fit the bill. It's not pensions that would necessarily in any way suffer. So that's something always to bear in mind. Having said that, when markets move and so on, you do get changed attitudes as to what the level of contributions from employees should be. So they do have a legitimate interest. We get involved with what we regarded as political issues with a small p, but there's cross-party political support. Our chairman is an independent member of Bedfordshire Council. There's constant media interest, but there's always more to do. The future. We remain a fund-based organisation. I did skip over it earlier, but apart from our 87 members, we currently, as I speak, have 6 of the 8 pools as members, but that will be 7 very shortly because the Access pool, which covers the eastern counties of Suffolk, Norfolk and Essex and Kent and so on, they have decided to join us. They just haven't sent in the application form yet, but I'm assured last week that it's in the process of being filled. So we will then have 7 of the 8 pools. The arrangement we have with pools, by the way, is when all the constituent funds are members of the forum, the pool gets complimentary membership. And that's what's happened with Central Pool, where you're a member, because we now have all members of the Central Pool, all the funds are members of the forum, and therefore Central gets complimentary membership. We have one pool that doesn't have that, that's London, because we've got one fund missing in London, and there the London Civ has chosen to pay the same as they would pay if they were an individual fund. So they pay the same as individual funds pay, and they are then a member as well. We'll continue to engage with and comment on all matters of interest to LGPS funds, and the long-term benefit will be more collaboration, more effectiveness. Benefits of money, benefits of membership from the LAF. We think it provides value for money. It spreads the research costs over 87 members and the pools, of course. Asset members reacting to pressure groups advocating divestment. We never say to a member, you should not divest. That is for them. We don't give investment advice. What we do say is that there's a question to be asked about divestment. If there's a problem with a company, or, you know, how do you necessarily help that problem just by selling your shares? If there's not a financial reason for selling the shares, then you should really think about doing it. If you're just doing it for environmental issues, then you're not necessarily fulfilling your fiduciary issues, concerns. But the question of selling, you might just be selling shares to an irresponsible investor, so you don't necessarily achieve anything at all. So we believe that far more important to engage with companies. Having said that, I repeat, we never advise people not to divest or to divest. That's a matter for them, and nothing to do with us. But we don't see the need to do it unless you see the need on financial grounds. Again, I repeat, it's all about collaboration and engagement nationally and internationally. And we because of our size, not only do we collaborate amongst ourselves, but we can collaborate with other major shareholders and with fund managers and so on. And it can save your officers time and cost in researching those issues. We don't formally have a slogan. This is my personal slogan that I've been using for many years, and I think it sums it up. And I hope I've been reasonably quickly in and try to keep the time. But if there are any questions, I'll do my best to answer them if we have time. Okay, thank you. Sorry for the voice, by the way, a bit of a sore throat.
Right. Well, thank you for the speakers so far. I'm Ian Howe. I'm the pensions manager, as I said earlier. I've got a eclectic mix of areas to go through from your assessment. So it's jumping around a little bit, but hopefully it'll have some interest in all the various areas that we'll discuss. So first one is KPIs, key performance indicators. This particularly came through on the scores from committee members rather than board members about how do we do the KPIs, what are the KPIs. We have 10 KPIs, 3 on business process and 7 on customer feedback. We collate those and we present them to the board every quarter. And the board obviously happy to make comment or any questions on those. And then we collate those as a collective and do them annually into the annual report as well. The 10 KPIs are as follows. I won't go through them line by line, but effectively we have 3 on business process and the rest on customer feedback. We have a target that we have to achieve or try to achieve in each of those, and then the actual scores are shown on there. So for example, I'll just pick the first one, the retirement benefits to members within 10 working days. Target was 92%, we achieved 91%, and that was for the full year 21-22. So all in all, for a section with, I think we have now somewhere in the region of 99 to 100,000 scheme members, we're quite comfortable, quite happy with those. Can always make improvements, but they're generally pretty strong results. Discretions, jumping to discretions. Ian earlier talked about the pension regulations. Now within the regulations, there's a sort of a subsection of the regulations that are called the discretions. And each of the fund employers has an ability to make their own discretions within the regulations. And there are 4 main categories which are listed on there. And broadly, all the 4 areas relate to cost. So depending on the view of the employer, depends on what their take on those discretions are. A very, very well funded, maybe a very generous employer may have more generous discretions than others. If that makes sense. The employers have to make those discretions in writing to us. They review them every 2 to 3 years. And then we record them. There are about 180 employers, I think, in the scheme, something of that nature. So we record all those discretions, we hold them centrally, and then when we're calculating benefits, any of the employers where a discretion is relevant in that member's individual calculation would refer back to that discretion for that employer before we calculate the pension benefits. Does that make sense? Great. Taxation. This is always an interesting area. There are three types of pension taxation: the annual allowance, the lifetime allowance, and when you're actually in receipt of your pension, the ongoing taxation of your income as pension. Now, the annual allowance, I will demonstrate an example of the annual allowance later in the slides, but that is the amount of pension growth you can have in any 1 year before you incur a tax charge. That is currently £60,000. The lifetime allowance is the total amount of your pension benefits. That's all your pensions, excluding your state pension. And that's currently at that magic figure of £1,073,100. Very catchy little number for you all to remember. Though that was actually changed in the spring budget, which I'll talk about shortly. But that was effectively negated in the spring budget of 23, whereby the tax charge applied to anybody who breaches the lifetime allowance became nil. So effectively, it did away with the lifetime allowance, if that makes sense. And then in 2024, they're going to remove it altogether. That said, there is still a tax charge on a maximum lump sum over £268,275. That's 25% of the lifetime allowance. So we monitor every case we do, and we check that, and we liaise with the individual as those breaches occur. And then, as I say, there's tax when you're in receipt of your pension. Any questions on the basis of that before we move on? Everybody okay with that? Great. So from 2023-24, the annual allowance is £60,000. As I say, that's the full amount of pension growth you can have in any year before tax is applied. Previously, it was £40,000. But if a scheme member's pension growth is greater than the 60,000, so therefore they exceed the annual allowance, what we're allowed to do is look at any unused allowance in the previous 3 years to offset that tax charge. That's designed to avoid people having tax charges just on one significant promotion, for example. So somebody's pension growth might be reasonably small or fairly static for year 1, 2, 3, 4, 5, big promotion year 6, big spike, but we can go back and look at the previous 3 years to offset the tax charge. Scheme members' 60,000 annual allowance can be reduced for people with specific money purchase pension arrangements. So there are cases where that 60,000 is reduced down. They are fairly rare, and those individuals will know who they are and they will tell us in those cases. So that's the responsibility of the scheme member if a member's annual allowance isn't £60,000. We have to calculate these and write to everybody who's breached by the 6th of October every year. And that's provided by HMRC statute, and that's a responsibility that we have to meet. And that's 6 months from the start of the tax year. So 6th of April, 6 months on, 6th of October, therefore you've got to write to everybody and tell them of any breaches. Does that make sense? Yeah, great. So I'm going to give you an example here. So this is where a member has breached the 60,000 annual allowance in 23-24 by £30,000. So if we look at the table, in 23-24, the annual allowance £60,000. But the member's pension growth was £90,000 in that year. And that's not an unrealistic value. That's a reasonably common value for somebody on high salary with lots of pensionable service, or somebody who's transferred in a lot of service in a year, or somebody who's paid a really large AVC or something of that nature in the year. So Carry forward, there's none because they've breached, and they've breached by 30,000. That's the first line of the table. Does that make sense? We then look back at the previous 3 years, as I said. So we look at 22, 23. The annual outs in that year was 40,000. The pension growth in that year was £30,000. So therefore they had £10,000 of carry forward. Year 21, 22, 2021, same applies. Carry forward of 20,000 in 21, 22 and 5,000 in 2021. You then add up the 3 previous years of carry forward. So add up the 10,000, 20,000 and 5,000. That's 35,000. That is greater than the breach. Therefore, there is no tax charge. Does that make sense? Yeah, brilliant. If the breach was still greater than the carry forward, then that does incur a tax charge. Then we'd write to the member, and the member would then decide how they want to offset that tax. Is that okay? We have in the region of around about 160 to 180 cases every year. And each one is calculated and we check them and write to them because obviously this is affecting individual members' taxation. So it's key that we get this right. Is that okay on that? Sure, question. Do you want to just put, oh yeah, great, thanks.
When you refer to pension growth,
yeah,
that just means simply, if I'm not mistaken, the contributions that have gone in that year. Is that right?
No, okay. No, it's not. Pension growth, it's a good question. Did everybody catch that? Pension growth, it depends on the type of scheme you're in, Zubair. So if you're in a money purchase or a defined contribution arrangement, it is effectively the growth of the pot. So as you say, how much you've paid in or how much the employer's paid in, how much is grown by. In a defined benefit scheme as ours, it's not that simple, I'm afraid. What we have to do, and I haven't deliberately put this in here because it'll be another 4 or 5 slides, but briefly, what we do is we look at the closing balance. We then look at the end of the starting balance, look at the difference in growth. We have to multiply the factor of 16 because that's what HMRC tell us for the pension, add back the lump sum and any AVC, and then strip out any inflation growth. So it's a more complex calculation than that, but principally, and if you do breach it, this is all spelled out in the letter, but principally it's spelled out and explained how that growth. The most common question we get is, why is it a factor of 16? And I don't know. HMRC tell me it's a factor of 16, and I've asked them countless times and they just say it's 16. So it's some sort of actuarial calculation methodology, I assume, but I'm not that scientific to understand how that factor is calculated, I'm afraid. If you do need more information, I'm happy to show you a sort of a broken down calculation if you need that. Is that okay with everybody? Great. Breaches of the law. Now, Ian earlier talked about the pensions regulator. One of the regulator's requirements is pension schemes have to monitor breaches of the pensions law. Now, I guess without going into the detail on the slide at this stage, there's got to be a sensible view taken here, because do you record absolutely every single calculation where there's a slight delay by a day over a statutory deadline, for example, or do you deal with the really significant breaches? Are you with me? Because otherwise you could have one person or 2 people just working on this all day. So what breaches are, and this has then been reported back to the regulator and developed over time, officers have to determine whether a breach is material or non-material. So that's really what I'm talking about one individual case, a day late, big breach. So material breaches are either high value issues or issues that impact on a large number of members. That's what the regulator states. So for example, a system failure that wouldn't allow us to run annual benefit statements. Therefore, no active member would get an annual benefit statement by the statutory deadline of the 31st of August. Good example, that would be a material breach. Are you with me? So what we would do is we would take that firstly to the board. With the board's agreement, we would then register that with the pensions regulator and we'd report that as a breach. We have, in my time as pensions manager, been here, I've been here 8 years, nearly 9 years, I think now. We've reported one material breach to the pensions regulator, and that was to do with the Prudential that we talked about earlier on, where the Prudential weren't providing us the information, so we couldn't calculate members' retirement benefits. They were material because people weren't getting their pensions and lump sums. We wrote to the regulator accepted there was a breach. We were not the only fund, we were one of many funds doing the same thing. They told us we had to put an improvement plan into place. We did. Hence the board met with the Prudential. We met with the Prudential. Prudential have improved. Still not perfect, but it's a lot better than it was. But that's the kind of materiality type of aspect. The pensions regulator will expect issues to be resolved or an improvement plan put into place if necessary. So that's how we record breaches. Any questions on that? Oh, okay, lovely. Employer outsourcings. We're jumping around, folks. Hope you're still with me here. So employer outsourcings can be quite complex and they happen all the time. We're having these all the time. Currently, we've got about 10 on the go, 10 or 12 on the go. So this is work that's happening all the time in the pension section. So the funding strategy statement was approved in March this year, and that was off the back of the valuation. But we used the opportunity to set out the policy for the outsourcing of new employers and employers leaving the scheme. It was already in there, but it's always good to review this and refresh it. So when a letting employer transfers out staff to a new private company, the contractor under TUPE, these staff still retain the right to their pension. Their pension protection is still granted. And that's under the regulation. So these people still have the right to the local government pension scheme. Does that make sense? So the question is, how do we ensure those people still have the ability to remain in the scheme? Because the company they've moved to may not have the local government pension scheme. So what we have to do is we have to set up a legal binding admission agreement with that new company. The fund's preferred choice is something called a pass-through admission agreement. And I know some of the people in this room have dealt with these. I'm looking at Ruth at the back. I know you had Ruth in your employer. We've had many an hour on this, haven't we? So this is happening with the employers in the scheme on a daily basis. Now, why do we use pass-through? It has advantages for both the letting employer, contractor, as well as benefiting the fund. It eases administration because effectively what happens with a pass-through is the contributions are still paid by the new contractor. The contract contributions normally 99% of the time mirror the same employer contributions as the outsourcing employer. At the end of the pass-through admission, any deficit or surplus moves back to the original outsourcing employer. So effectively, from a actuarial asset and liability perspective, it's the status quo is maintained. That's why we do it. From the fund's perspective, the risk is reduced because we know the assets and liabilities are resolved. Are you with me? The members are happy because they're still in the local government pension scheme. Contractors happy because they know at the end, as long as they've met their contributions, they're done and they can walk away. And the outsourcing employer is happy because they know the contributions are still being paid at the same rate as they would have paid them previously. Does that make sense? There are others. There are bulk transfers to other local government funds as well. So that's where there's more than 10 people involved in a bulk transfer. Again, sorry, Ruth, I'm picking on you again. We've dealt with these as well, haven't we, with your employer? And this is where the two actuaries, our actuary Hymans, Ian's colleagues, and the new actuary of the new scheme have to agree the actuarial methodology used in the calculation of the transfer of the assets and liabilities in those cases. They can be quite timely and they can also be quite expensive, bulk transfers. And then there are full transfers to other funds, and that's a full transfer out of all active, preserved and pensioner members. They are pretty rare, but we have had a few. They tend to be academies that are moving into multi-academy trusts, and the head office is in another geographical region of the country. So it could be in Nottinghamshire, for example, where the head office is, got one academy in the Leicestershire fund, and they want to move it all across into the one fund at Notts, and that's a bulk transfer. Any questions on those or any of those elements? Everybody okay with that? Great. Employers leaving the scheme. So touched on some of this already, and I won't go through it again. But if the existing contractor loses the contract under pass-through, as I said, the assets and liabilities are effectively nullified. It's the same. It's the status quo. If the contract is pre-April 19, that's before pass-through. We introduced pass-through in April 19. If a contract is before that, and we still have some of these, the contractor must pay a termination valuation to the fund. So what we do is when the last member leaves the scheme, we ask the actuary, again, it's Ian's colleagues over there, Hyman's colleagues, to calculate the cessation termination value. So what the actuary is doing is it's calculating how much money is needed from that employer to pay off all the ongoing liability for those people's pensions. That money is paid to us. The employers then met their responsibility and then walked away. There are issues if the employer can't make that payment. And then we enter into things like DDAs, which are deferred debt agreements, and various, there's others as well, which we can do. But we manage this, and this is all managed within employer risk. We have a section within the pension section that deals with employer risk and employer work. And then employer mergers within the fund, causing the closure of one of the employers, as I say, a transfer of the assets and liabilities by the fund actuary will be required with the possible recalculation of the ongoing employer rate. Does happen, again, it tends to be academies where that's the most common area. Are there any questions on that? I know I've whizzed through that one, and that's quite a big section, but are there any questions on employers leaving the scheme? No? I guess majority of you in here, this is just something that happens in the background. This is the mechanics of what we do in the pension section, but ultimately what we're trying to do is make sure there's enough money to carry on paying those pensions. Nick, do you want to just pop your mic on, Nick? Thanks.
Yeah, very quick. In terms of an employer who's leaving the scheme,
yeah,
what's to stop an employer sort of giving everybody a massive pay rise right at the end and giving a big increase, which then has a hit on the actual fund value?
Yeah,
the employer has to underwrite.
It's a good question, Nick. We have a very strong relationship with the majority of our employers, Nick. And if I get wind of anything like that, I will be onto them, is the honest answer. I do have these kind of conversations occasionally with employers, but they would normally ask me. If it feels as though it's going to be something that they are genuinely going to do, then I would point them towards their legal admission agreement to point out, these are the rules you've got to meet here. And are you aware this could really up any termination cessation that you're thinking of triggering here by doing this? Are you with me? Normally when an employer has considered it in the wider context, they wouldn't do that. But to be absolutely brutally honest, they could still do it. But if they do, they're going to pay for it, Nick. Yeah, because that would actually trigger an increase in their cessation value. Does that make sense? If it was a pass-through, is that where you're going? Got you. If it was a pass-through, it would be in the admission agreement to stop them doing it. So as an example for you personally, if it was somebody like Turning Point, as an example, that will be in the legal agreement to stop them doing that, Nick. And if they were to do it, you could then push that back to them with me. Is that all right? Great. But good question, Nick. Thanks. Anybody else got any questions on that? No. The risk register. Now, Boulash has kindly handed out a copy of the risk register. You should all have that on your table. We split the risk register into 6 groups, 6 areas. So all the risks are split into these 6 areas here. Following the work that Kat did a lot of work on the net zero recently, and comments around that, and the Vactiv's valuation, we had a review of the risk register recently, and we've done a review of that, and that was from comments from committee members. So the latest version is with you there. As I say, what we've done is we've looked at each one individually. We've got them into the categories, as I say, and the scoring on the risk registers there. The first set of scores are before the mitigating changes have been made. So what we do is we look at each risk in 2 areas. We look at it by impact and likelihood. That's what the I and the L are. We multiply those together and that gives you a risk score. We then put in mitigating changes to improve those risks, to manage those risks, and that's the second set of figures, again with the risk score time multiplied from the I and the L, the likelihood and the impact. I don't propose to go through each of the risks on here. We haven't got time to do that. But has anybody got any questions on the risk register or risks generally, really? Is there anybody wants to raise? Yeah, sure. No, nobody, no risks. Okay, sure. The biggest risk, who's got the scores on the table? Can you tell me what the biggest risk score is? Boulash, do you know off the top of your head? You want to just pop your mic on, Boulash, for me, please?
Sure.
No, we've got no red risks. No
red risks. And then after we've added the mitigation, I think the high score might be seen a 9. Seen a 9.
What would that be on, Boulash? What's the highest?
Back to it.
Thanks.
It's the new risk, and it's titled the risk to fund assets and liabilities arising from climate change.
Climate change is the biggest risk.
And that's a 9.
And that's a 9.
3 and a 3 then, so likelihood 3, impact 3.
And I guess that makes sense really, because that's new, it's developing, and it's a very strong, strongly represented area at the moment. But I think the fund's done a lot of work in this area in recent times, so I think that's good. Some risks will always have a high impact. They might have a low likelihood, but they will always have a high impact. For example, I don't know, I'll just pick an example. Cyber security. If somebody did break into the pension system, the impact would be enormous. The likelihood of it happening is going to be low, but it's always going to be a risk that's there. So some things you just have to manage as best you possibly can. And we do review this every quarter. We take it to the board every quarter. Board members are obviously welcome to make comments, and then we take it to committee as well. Is that okay in terms of an answer, Councillor? Is that okay? Is that all right? Great. Thank you. I shall move on. Sure. Sorry.
Just a question. There was, I think, whether maybe you might have mentioned one of the other speakers about the level of risk appetite you might have in terms of specifically around investments. But just looking at the risk register, when you look at the residual risk scores, or sorry, even ignoring that, I suppose, is there a layer above this which says which of these risks are within appetite, very comfortably within appetite, or stretching
It's-
us beyond appetite.
Yeah, we do it purely from the scoring, to be honest,
Okay.
Zubair. So anything that gets into the red, we would escalate clearly. And there isn't anything in that, but anything that does go up, because scores do go up and down. I mean, we obviously try and bring them down, but naturally some will go up. So if there is an area that is increasing or we're uncomfortable with it, we would take that, escalate it forward initially, but obviously officers would look at that first. Bulash.
Just to add that we've also got the appendix there, the other big A3, which kind of tells you the risks and there you go. So Zubair's looking at it here. So it's this sheet over here. And kind of defines the risks from running whatever score. So you can have a feel for the impact of that risk if it's classed as a 4 or a 5.
Is that okay?
Yeah, I think where I was coming from, and maybe something we can pick up later, is if we were to plot these in terms of within appetite or above or below, if we were to find all of these were within or below appetite, does that mean there's an opportunity for us to maybe look at a bit more risk?
Oh, I see. I'm with you. Yeah. Sure. I understand. Sorry, I beg your pardon. I'd probably have to consider that with Bulash and Declan, to be truthful, because I'm guessing that would probably be more, I might be wrong, but I'm guessing it's more probably on the investment side in terms of where we decide to look at investment opportunity off the back of this, which I would probably lean on my colleagues, to be honest, but we can maybe take that offline. Is that all right? Does that seem reasonable? Great. Employer covenant, we have to assess the risk of the employers. We have multiple different types of employers in the scheme of somewhere in the region of 180, as I say. But within that, there's different types of employers. So there's the big stable councils like the city, the county, the boroughs, the districts, right through to really, really small employers with maybe just one member of staff, like a town or a parish council. You've got the universities, you've got the academies, you've got the community admission bodies, which tend to be smaller charities, possibly without security. And then you've got the TUPE transferred employers, like the ones I talked about earlier, Turning Point as an example. So we have a variety of employers. So we have to assess the risk of the employers. And where we feel an employer is at greater risk to the fund, we put in risk covenant effectively. So that could be a guarantor. I know, Zubair, we've talked at length, haven't we, on your employer on this. And there's various ways we can do that. But ultimately, it's there to protect the fund so we can carry on paying the pension benefits. Because what we don't want is an employer to go bankrupt, have no money, have no security, have no guarantor, and then the liability for paying those pensions then gets spread among all the other employers. That's a bit of a hard message to sell to the other employers when they've got no control over that. Does that make sense? So it's managing that. So this is an area that's really key and is growing. And it's a part of the work we do as part of the valuation and ongoing. That's my part done. Is there any final questions for me before I pass on to Bulash? No? Well, thank you for your time. Thank you. If they want to, by all means.
Looks like we're about ready to go again. So we've got, I think, all of about 10 minutes left. And thankfully, I think there's only 3 slides left for me. So it won't be a long slog to the end. Right, so from the self-assessments, we came up with 3 areas in this section that weren't scored well. So that's the investment strategy statement, the fund's strategic asset allocation, and then manager monitoring. So we've got 3 bits left, but I have left on each table some slides that will probably help us run through it. So the first one is the investment strategy statement. We have some associated policies with that as well. So that's the net zero climate strategy, which was approved in March 2023 after about a year's worth of work, and the funding strategy statement, which is the part that Ian works on with the actuary Hymans. The frequency of the updates. So we've got the investment strategy statement, the funding strategy statement, and the net zero bit. So we've got an annual smaller update for the ISS and then a bigger 3-year update. And we do something similar with the FSS, and for the net zero climate strategy, we said we'll do a 3-year update with an annual review to see how we're getting on. The ISS is a fairly easy read. I'd like to say it's sub 20 pages. You will learn a lot from reading it, I'd say. There's a short section on governance. We've got 5 main areas really. So we've got governance, fund objectives, and management. The governance bit's really short. The fund objectives we've heard regularly through today, which is regarding the primary objective, which is to pay pensions and lump sum benefits. And then the management is how we manage the Leicestershire County Council's pension fund here, which is, you know, taking a long-term investment strategy with regular reviews and a link to the FSS. Second section is the asset allocation, how it's updated, how we rebalance. It goes on to the second slide, actually, so we will come back to that one, and we've got some handouts to help. The third section within the ISS is the funding risks, the asset risks, and the other risks. So not only does it list the risks within the fund, but it also states how we manage those. An example might be within the funding risk, financial mismatch. So, you know, the assets don't grow fast enough to pay the pensions. A different asset risk might be illiquidity. So we can't sell enough of the fund to be able to pay pensions as well. So we've got to manage a whole host of risks within the fund. Pooling, LGPS and LGPS Central, so kind of one and the same. We heard earlier that we're an 1/8 owner of LGPS Central. In total, those 8 local authorities, ranging from Cheshire up in one corner, ourselves in the other corner, and Shropshire in the kind of southwestish corner. Over 50 billion in assets altogether. About half are pooled so far in total. The company's about 5 years old, and within the ISS, we talk about our thoughts regarding pooling and how we're supportive of it. Last section in the ISS is regarding responsible investing. It describes our ESG approach, so environmental, social, governance approach, how LGPS Central helps deliver that. You know, they've got a much bigger team than we have here. We've got a fairly small team. They've got specialist tools there to help them, and a specialist team on top. They also have an RI framework, which was last updated earlier this year. Again, linked within the ISS, and their beliefs at Central have been endorsed by our committee as well. Just move on to the next. I said on the last slide, asset allocation. So this was one of the areas that didn't come back well scored, if you like. There's a handout. I think it's the A4 smaller piece in there somewhere, which should help. It looks like this one. It's the only spare one I had. Let's have a quick run through. So we've got what our allocation looks like currently and last year. So we've got this column here. That column there is our 2023 strategic asset allocation, SAA. Column before it was last year. So you can just see the changes that were approved year on year. We've got our actual weighting just here in this column. So that's at the latest valuation point at the 31st of March. And then you can also see the difference. There's fairly large differences currently because we've only just changed in some areas. But this is one of the most important bits that the investment strategy looks at. Once a year with Hymans Robertson, we use one whole committee almost. So it's a January committee at the start of the year. You can see that we've got a fairly large reduction on the top line there. For listed equities, we've got 4.5%. We tend not to make fairly big movements year on year. At this point in time, we've been moving consistently over the last few years to move away from that asset group, which is described as the top three there, the listed equities, the private equity, and the targeted return. You can see they've come down as a cohort. The money's effectively moved into the next cohort, which are classed as income assets here. You can see infrastructure's gone up by 2.75, and that's 2.5 within emerging market debt and credit in general. So we're moving over time away from what might be described as the riskier parts of the investment spectrum to something which is a bit safer, slightly lower returns, but provides regular income. So that's the kind of multi-year plan. It evolves over time. It's something that we look at once a year. We take into account responsible investing changes as things change in the market. We've been adding managers only if they can demonstrate the same values we do. So if they can't demonstrate that they take climate change or ESG seriously, they don't make it onto the roster. We look at our funding level, calculated once every 3 years. If we don't need to take excessive risk, we dial it down. We don't make sudden changes, but we dial it down gradually over time. We have a look at the medium-term investment outlook as well. Again, from Hymans Robertson, we have annual regular reviews, but we also have quarterly updates as well. Any investments that we make into any of those asset classes come with Hymans approval. It's a fairly important part. We run it once a year, like I say, as a holistic review. On that A4, you can also see some rebalance ranges as well. So that's how we rebalance. If we get ahead of where we need to be, that area should be sold. Again, there'll be some areas where we're below, and those are the areas that need to be bought. Any questions at this point?
The pension.
Okay.
Just tell me.
Okay, so that's probably the number one risk on the risk register, to be fair. Where the assets don't grow big enough to be able to pay the liabilities. Now, at any given time, the fund can perform poorly. If you think back far enough, March 2020 was a poor time. When COVID first struck, all markets were down circa 20%, but they tend to recover. What we also have within the roster of managers is areas that should perform well when other markets aren't performing well. So one offsets the other. And that's this section at the bottom here. They're dubbed protection assets, and they should perform contra to the growth assets. Last year wasn't a great example where both performed poorly, but that's not been the case historically. Does that help? Okay, so we still have a triennial valuation, and that would, I think, in your doomsday scenario, the funding level would drop well below where we are now. So we're at 105 now, Ian. 105 now. So we've gone from, I think, mid 70s 6 years ago, late 80s 3 years ago, 105 now. It would take a hell of a doomsday event for us to get into a position where we were really poorly funded again. Not to say it can't happen. Anything can. The only thing that would happen then is employers would be urged to pay more. That's the balancing part. Employee contributions are fixed. Employer contributions move up and down. Correct. And that's the triennial review where we set employer rates. So every 3 years. Any other?
Yeah, just about liquidity. There's not much mention of cash there. How do you actually manage liquidity to physically pay the pension?
So we always have an amount of cash on hand. You can see here the actual weighting's at 1.2, so that's about 60 million, more than we need. We actually plan to have as little as possible. So yeah, we try to have zero. Very hard to have zero. Not whilst I've been here. We, you know, I think 1 or 2% is fairly reasonable. What you don't want to be doing is selling parts just to pay pensions. You want to run a little buffer. I mean, there was a time where money was almost free. Having cash didn't really hurt you, but now you want to run as little cash as possible because there is a cost. So yeah, so we have plenty of liquidity on hand, and that's part of the reason for increasing the allocation to that asset group in the middle called income. They're regularly paying dividends, if you like. So there was a time when interest rates were close to zero. If you held cash, it didn't really matter too much. Now you can get money, you can get paid to hold cash, can't you? So we want to hold as little cash as possible if we can help it. Any more? Right then, shall we move on to the last of the three? So another area that came up was manager monitoring. What did it mean? We've got at every quarterly local pension committee meeting, the aim to review one manager. So we try and bring in one manager into the room every quarter. It's LGPS Central's turn this Friday. They'll be in to talk about public markets. So that's effectively public markets that they've got listed equities. We've got listed equities with them in the main, so they'll talk about those. We've got a link there when you do get the slides to all the previous meetings, and there's a few examples there of prior meetings. So we've got Partners Group who do private credit or private debt back in March 23. LGPS Central came in January. They talked about their private markets, infrastructure and the like. And prior to that, back in the last year, we had Aegon, who we have 2 mandates with, corporate bond mandate and an index linked mandate. You've also got on your table a very hard to read small A3, which is our quarterly performance management report produced by an external company called Portfolio Evaluation. They take the full roster and look after management of performance. I could see Clive. I need glasses. Even I need glasses for that now. So yeah, you can see quarterly performance, 1 year, 3 year, 5 year, and in some cases since inception. So we've got external measurement as well. Last 2 bullet points on this slide, LGPS Central. So we've got additional specialist resource and they provide us greater depth and regular reporting. We get lots of reports from them. I think there's a little A3 pack there, which is an extract from their 100-page report that they send us once a quarter, and it's the colour one, in fact, which is talking about it's the Climate Factor Fund, we call it. It gives you an insight into how well that fund's been performing, and we get that once a quarter as well. On top of that, we also have from every manager on that huge A3 slide a quarterly report. It's included within the private section of each quarterly pack, which effectively turns that pack into a 1,000-page report. But it's there if anybody's got any particular interest in a particular manager or a particular asset group. I make that 5 minutes over, but has anybody got any questions? Okay, thank you.
Thank you very much for your attendance. I hope that has been useful. I know we've covered an awful lot, and I think it gives you an indication of how broad pensions is, from investments to securities to all sorts of different things in there. So thank you again for your attendance. If you have any further questions at the end that you think of, let us know and we'll come back to you. But other than that, appreciate your time and wish you all a safe journey home. So thank you very much. Thank you.